Are you ready to try your hand at placing your very first stock trade? Then check out our free guide, 10 Steps to Choosing Your First Stock to Trade, the Ultimate Beginner's Guide. In this free download, you'll learn how to choose the right kinds of stocks and how to find them, know when to buy your stocks and when to sell them, and you'll learn how to take your very first steps to becoming a stock trader and much more. Grab your free guide now by going to TRADEway.com/guide. That's TRADEway.com/guide. Hey guys, I'm David Mitchell, founder and CEO of TRADEway. What if God himself gave you a blueprint for how to handle your money? Well, the Bible is a practical book. Let's dive in and see what it has to say about wealth, about risk, about leverage, and about investing, and uncover how trading in the stock market can be a powerful tool for moving towards your biggest goals. We're so happy you're here. This is The Word on Investing. Hey guys, welcome to the podcast. You know, recently we were talking about some very practical steps you can take if you think you're getting into a recession. And today I want to talk to you about some specific tools that we can all use to know where we are in a market cycle, specifically when we might be moving into a recession. And these are great because they're free. You can go out to Google and type these in and find them yourselves. And so I encourage you to do it because it's a great way to know about the market tone. Now remember, at TRADEway, we talk about three legs on the trading table. We have to look at the fundamentals of the stock, which means how good is the company, how good are the products, how good is the management. That makes it more likely perhaps to go up, right? And then secondly, we look at technical analysis, and that's where we use charting to know where good potential buy and sell points are. And then this one has to do with really one of the most important, which is market tone. In other words, what's all the news saying out there in the world? What's the economic news and just the world news saying that might affect our stock trade? Well, within that big topic of market tone, we have several indicators that in many cases the government provides that we can look at that gives us a clue of where we're headed. And we, of course, base that on the past, which is not always a perfect prediction of the future, but it's something we definitely need to look at because God has created everything in this world in cycles. Everything in the universe seems to cycle. And so it's definitely something we need to watch. It's almost like looking at patterns, except we're doing it with the numbers. So let's look at the first one. You can go out to Google and type in the Conference Board U.S. Economic Outlook. And I'm looking at the one here that I believe was current through April of this year. Now, you realize at the time this was done, the third and fourth quarter were sort of projected. But it's just interesting to see what some of the smartest economists in the world think about the future. So when you look at this particular chart, it's got 10 or more key components. And they're not all important, so I'm going to tell you which ones I think are important. The first one is called real GDP, and that's going to give you some numbers about what they think the overall production of our entire country is going to look like as far as economic production. And so when you look at these numbers, they're kind of interesting because the first quarter of 2023, it was a positive 2. And the second quarter, that changed to a minus 1.8, and those are actual figures. And then for the third quarter, it predicted it would stay at minus 1.8, and then the fourth quarter at minus 0.6, which is a little better, correct? However, remember, that was a projection that was made over a month ago. So actually, I think that fourth quarter would look more like a minus 3 at this point. And seriously, I mean that. So, you know, when you go from 2 in the first quarter to minus 1.8, and then third quarter, they are predicted minus 1.8. And then the last one, we're thinking more like minus 3, because the truth is, ladies and gentlemen, the recession hasn't even started yet, and it is going to happen. So people that may feel that things are awfully bad now, you ain't seen nothing yet. I mean, you're going to get to the place, like I've said so many times, where you drive by a new car place and you're going to think, that poor soul will never sell another car, which isn't true, of course, because there's always a next new bull market, but it feels that way. And you feel inflation, you feel all of these things, and you just start to sense it. In fact, everybody does. And we'll talk about that. That's another indicator we'll talk about in a little bit. So those numbers are moving towards bigger negative numbers. Now, if you look at real disposable income, that's the amount of money left over after you pay all your bills in any given month. And it's looking at everybody in the country, how much money is left over after they pay their bills at the end of the month. Well, inflation can certainly destroy this one, right? So this one, first quarter said 7.5. The second quarter said 0.5. That is a huge drop that's already happened. The third quarter, they projected 0.3. And then here again, fourth quarter, they went up. They're trying to be positive about it, but they're going the wrong direction there. They said 0.6. I'm going to guess probably around 0.1. Okay, so 7.5 to 0.5 to 0.3 to 0.1. People are having less and less money to spend. What does that tell you? It's going to hurt all of the products of all the companies, which is going to affect all the stocks on Wall Street. And when I say all, it's not really all. There's always a few defensive stocks that can actually go sideways or up a little bit in a bear market. I don't even like to trade those, though. Some people think, oh, that's what we need to jump into. No, really, it's better to jump into puts on the ones that are going to tank. And we'll talk about that. That's an option called a put option. A put option is just an option that has the potential to make money when the market goes down. It's, to me, way better to find these stocks that are going to crash and buy puts than it is to try to find a defensive stock, where you can try to make it go up in a bear market. You're kind of going against the flow. So the point is, the real disposable income is hurting, and people aren't going to be buying products and services as much. Of course, the products will go down first, then later the services. And so it's going to hurt the companies, it's going to hurt the stocks. So there's huge opportunity. Now, see, right now your neighbor is scared to death. But when you have skill sets like you get at TRADEway.com and you take advantage of our educational programs, when you have those skill sets, there is no bad market. I mean, you say, oh, it's down market, that's bad. No, down market is good because you learn how to buy puts that give you potential to make money on the way down. You can also buy inverse ETFs that are not options. They're like buying a stock, but it makes money when it goes down. All of that's available. You just need to check it out at TRADEway.com. We want to help you. We want to help you get there where you can do trading as a business if you want to, and even teach it to your kids and grandkids and have potential to create generational wealth. Now, the next one is called real consumer spending. Started out first quarter 2023 at 3.7, and by the second quarter, it dropped to an amazing minus 1.6. Then they predicted minus 1.6 quarter three, and that's going to be minus 2 or more, in my opinion. And then quarter four, they put minus 8, so they're optimistic and going up. They should be going down. So probably be minus 2.5 by the fourth quarter. And so what that is, real consumer spending, people aren't going to be buying much. That's going to hurt the whole country. People are going to get laid off. Because see what happens when we stop buying the products, the companies have to fire people. So then people don't have money to buy the products, and it creates a vicious cycle. You see it? It's really frightening, isn't it? Well, if you have skill sets, you don't need to be frightened. You use puts and you use inverse ETFs, and you have potential to make money when all these companies are going to be crashing. Now, the next one is residential investment. And this is where people are investing in companies that build houses. Wow. First quarter, that was minus 10. Second quarter, minus 10. Third quarter, they project minus 10. And the fourth quarter, minus 5. I'm going to say minus 12. So people are buying less and less residential houses. Why? The interest rates are going up. I just spoke with a builder yesterday, a friend of mine who's a builder, and he said, man, my whole portfolio of clients just dropped because one after another, they're saying, you know what, we're going to hold off on building that house. The interest rates are just too high. I'm telling you, real estate's about to tank as well. It's a bubble. It's about to go down. So it's not a great time to be buying a house. It's a pretty good time to wait just maybe about 6 months and sell real estate. Wait for it to tank for 2 years and then jump in and buy it cheap. That's how the big boys make their money. That's how you can do it too. Now let's look at another one, non-residential investment. This is like commercial, right? And it was 1.6 the first quarter, minus 0.8 the second quarter. They projected minus 2.3 the third quarter and minus 1.5 the fourth quarter. I think they're being too positive. In my opinion, it's going to be closer to minus 3 the fourth quarter. Just read some huge articles this past week on how frightening the commercial real estate world is looking. I think about it. After COVID, people quit going to work anyway. These skyscrapers are empty, and the people that own them are backed by banks that really own them, and the banks are in trouble. Another big one bit the dust just yesterday. Now, I know we're recording this on April 26, 2023. That may not be the case when you listen to this, but we've just had 3 large banks go under. Now we got a 4th one that's a regional bank that is just about to go under today. And that is, all of these are signs of a really bad market crash and recession. And I know the market tanked all of 2022, but then it moved up until now a little bit, and mostly sideways, but a little bit up. And that's a fake out that Wall Street's doing. Trust me on that. We're going to have another second leg down on this thing. I'm going to show you how much in just a little bit here. So let's really be watching the commercial real estate area, because it actually could help create what we call systemic risk in the entire market, which means when a big company or a big industry group goes down, it takes the whole economy with it. We got to be really careful with that and keep an eye on it. Another one is total government spending. Even that's going down from 3 to 3.2, went up a little the second quarter, but they're projecting down to 2.3 and 2.5 the end of the year. So if the government's not even spending money, that's really, the economy's in bad shape. And then exports, the amount of products and services that we're sending out to other countries to make money for our country, started at 4.5. By the second quarter, it dropped to 2. Third quarter, 0. Fourth quarter, 1, but I'm going to say minus 0.8 in my opinion. Now, imports, where we bringing money in and buying things from other countries like China or who knows, it was 1 the first quarter, minus 1.5 the second quarter, indicating that we don't have as much disposable income. And then even companies don't, which are buying products from other countries and maybe marking them up and selling them. It went to a negative number the second quarter. They're projecting 0.4 the third quarter and 2.5 the fourth. I'm going to say, in my opinion, that's going to be probably still minus 1 the third quarter and still minus 1 the fourth quarter. And then unemployment rate, well, 3.5 to 3.6 to 3.7 to 4.2. It's climbing. Why? The Fed is raising interest rates, which means they're not printing money, which means the money supply is going down, which means people can't get bank loans, nor can companies, so they can't grow. And eventually, when this all cycles in and people start losing their jobs because of inflation and people not buying products as much, then the unemployment rate's going to move up. And it shows that it's already doing that. And then core PCE inflation rate, which is the big one that the Fed looks at. It was 4.6 the first quarter, 4.2 the second. They're projecting 3.7 the third, but I think they're going to be a little off because it actually did go down a little, but it is starting to move back up again. So I'm going to say I would suggest maybe 3.9. And then they're saying 3.1 for the fourth. I'm going to say probably 3.7 for the fourth. So it is going down a little bit, but you remember they want to get that to 2. And I'm going to talk a little bit later about how in the Carter years, it took a lot of time to get it from a certain level around, a high level down to 2. I'll show you how much time that takes and how much pain you got to go through as a country to get there. Okay, so looking at these numbers, like the real GDP, the growth of the entire country's production is going the wrong direction, or you might say the right direction for a recession. So is real disposable income. People don't have as much money to spend on products and services. So is real consumer spending. They're spending less and less. Those numbers are real, folks, and they're out there. And Wall Street's trying to make you think the market's just going to keep going up. I mean, there are articles every day that say it is. They're fake news, okay? And then residential and non-residential investment, both going the wrong direction. Total government spending's not even helping. Usually the government tries to go in and build some roads or something to give people jobs, and they're not doing it right now. Exports and imports look bad. Unemployment is moving up, and inflation is not moving down towards 2 nearly as fast as they're trying to make people think it will. Now, you probably noticed they had projected a little better numbers the fourth quarter, but remember those projections were done over a month ago, and now numbers have changed, and those are not going to be as positive. And so that's why I suggested those numbers are off. They're going to be worse rather than better. All right, so Now let's look at another chart we could find. You can look it up at Google, just put in global leading indicators. And sometimes you can Google the phrase global recession tracking. But either way, you're going to find this. It is a chart of leading indicators. In this particular chart that I'm looking at has two squiggly lines on it and then some gray areas that are vertical. The two squiggly lines, there's a yellow one that is actually the leading indicator, and that is a group of things that these economists look at, and they put it together in a math formula that'll draw this line that through the years has tended to be a leading indicator of what the economy is about to do. And that's the yellow line that I'm looking at here. And then the blue line is the GDP. In other words, our economy, the picture of our whole economy. So what's interesting, oh, and by the way, the vertical gray areas are recessions that actually happened in the past. So what we can look at these, if we go all the way back to 1982, we see this big gray area where there's a really bad recession. And if you go out just several months before that started, before that little gray bar that's going up and down on the chart, before that starts, several months, the yellow line had been steeply going up and then it began to steeply go down. And as that went down, the leading indicators went down, all of a sudden the GDP followed it down. So as you see both those numbers moving down, it predicted a recession, and it was a very good predictor. Now, if you go out to 1991, just prior to 1991, there was another recession. And man, if you look at that leading indicator line, it had been moving down for almost a year. And then just prior to it, it moved below the zero line and just tanked. And so did the GDP. And then we had the recession. Okay, you can see that again in 2008, the same idea. You can see it again, though not as much, when we had the COVID recession, because that one was a big surprise that happened quickly. But what I'm interested in is, what does it look like right now? Well, if you just go back over the last month or two, towards the end of 2022 and the beginning of 2023, the yellow line, the leading indicator line, has been moving straight down since really about February of 2022 and is continuing straight down now. And the GDP line has been moving down as well. So it's predicting a recession big time. So that's an interesting chart to look at. You can see past recessions, you can see how good these indicators are, and you can see what they're indicating right now, which is recession. All right, here's another one. You could go out there and just type in Consumer Confidence Index, and you'll find this really cool chart. It's got a squiggly line moving up and down, and then it's got these vertical gray areas which show where the past recessions were. So if you look at that big bad, we call it the Great Recession in 2008, 2009, if you look at this consumer confidence chart, it had moved down significantly just prior to it, right around the end of 2007. And consumer confidence is where they take these surveys and ask people, how are you feeling right now? How are you feeling about the economy? How are you feeling about keeping your job? And things like that. And they combine all of those answers and create this chart. Well, it was moving down rapidly at the end of 2007. And then you had this really big thing we call the Great Recession in 2008 and 2009. So now if you come forward to right before the COVID recession, it wasn't quite as much of a leading indicator here because COVID just was a surprise. It just hit, boom, and there it was. But it did move down rapidly at the very first moments of the COVID recession, indicating we're about to have a bad recession, or I should at least say a bear market, and it was a bit of a recession. So the question is, what's it doing now? Well, if you go back to 2001, about a third of the way through, let's just say starting with the second quarter, it hit a high right there. And from that point until now, it has been moving down. Now, it doesn't move straight down in a straight line. It looks like a stock chart. It kind of squiggles up and down, but the downward trajectory is very clear. And if you look at the first quarter of 2023, it finally hit a high, kind of right about the middle of the first quarter, and it's been moving down ever since. So in my opinion, consumer confidence, oh, by the way, I just saw a brand new report on that today, very negative. So this indicator is predicting a recession. All right, here's another one you can look at. It's kind of creepy, this one. It's called Emerging Economies. I found this chart in an article that you could Google entitled Emerging Economies to Remain Key Engine for Global Growth. Now, what's interesting about it, it's talking about emerging economy countries like China, India, and other emerging countries. And so it shows bar charts with global GDP growth in these areas. And what's interesting is if you look at, say, India, it's 0.4. Okay, if you look at China, it's 1.0. But if you look at the United States, it's 0.2. If you look at Europe, it's 0.1. And other mature economies, it's only 0.2. And when you look at the bar chart, it looks like everything in the West is tanking and doing very poorly, and not even as well as third world countries. And so I'm not suggesting that you should use this to talk yourself into going out and buying emerging market stocks, which is what Wall Street will tell you to do. I would not do that right now at all. What I would do, I would go out to TRADEway.com, take a couple of courses and learn how to do options trading, and I would be buying puts on stocks that are headed down. And we'll show you how to do all that. And man, it's fun. It's the most fun thing you can do, I think. But you should check that out, because if it's true that the U.S. and the Western economies are tanking, then we need to be buying puts in the stocks in those countries, especially the U.S., because they have more volume and it's better to trade stocks with a lot of volume. So we'll do the U.S. market, but we can be looking at puts and inverse ETFs. That's where we should be looking. But you have to have the proper skill sets. Don't even try it if you don't. But listen, if you'll take a look at our educational programs out there, wow, it can change your world. All right, let's look at another one. This one is really interesting. It's an S&P 500 bear market and recoveries chart. So if you just type in S&P 500 bear markets and recoveries, you'll find this chart. And what it does is it goes back and it shows bear markets going all the way back to August 1956, okay, and coming forward to the present. And what it does is it shows how long it takes to make your money back after you lose it if your financial advisor leaves it in the market all the way to the bottom. Now, let me tell you something. TRADEway has a division called AMPT, A-M-P-T. We are a FINRA-registered investment advisory company, which means we can help you with your retirement money. Now, if you've got a 401k, we don't do that, but you can call your manager and say, hey, how much of this fund can I roll over to an IRA? And then once you do that, we can help you. And here is why you might want to think about AMPT at TRADEway. It's because our main goal is we just simply don't leave your money in all the way to the bottom of these corrections and bear markets. Whereas the other financial advisors, most of them really do. They don't want to go to cash because they're afraid you'll ask for your money. Well, we'll go to cash. And what's cool, when we go to cash, at least right now, you're making about 4.25% interest on the cash while it sits there. So when we see the opportunity to buy inverse positions with your money, which gives you the potential to make money when the market goes down, we will do that. So we're either going to be in cash or inverse positions as the market moves down into a bear, whereas your neighbor over there, they're just going to say, hey, stay the course. It'll come back someday. Well, that's where this chart shows different. If you go back to the 1973 bear market, it took 69 months just to make that money back that was lost, which means for 69 months, you're making no money with your money because you're just you're clawing back to get where you were. And if you go back to the 2000 tech bubble when it burst, the market fell 31%, but it took 56 months to make that money back and get back where you were. See, our philosophy would have been for our clients to be in cash or inverse positions so that at the end of that 31-month route, you would have the same money roughly that you had when it started, or maybe a little more if the inverse positions worked, and then you start from there and you didn't lose any time. Plus, you can buy in at the bottom of that market when everything's cheap. I mean, that is our philosophy. That's what we attempt to do for you guys. So you think about that. Check out AMPT at TRADEway. Now, I almost left this one out. What about the 2007 and 8 crash? Well, that was 17 months in duration, and it took 49 months to make that money back. So where are we now? Where are we in this recession? Well, the one in October fell 17%, but the one back in 2000 fell 31%, and the one back in 1973 fell 21%. So already this particular market we're in now has fallen about 27%. We've only done one leg down and then a slight attempted recovery. I think it's going to do another leg down. So it's either going to fall down beyond 27 to at least 34, maybe to 50 something percent negative in the one we're in right now. That's just my projection. So think about that. You might want to be with a company that will leave your money in cash or go to inverse positions rather than staying in these stocks all the way to the bottom of this crash, right? So even if even if you were in the market with an advisor that left you in during 2022 and you lost a ton of money, that's just the start. So if you go right now and you grab that money and you put it with Amped, we will keep it out of the market the best we can. And if you go back and you look at our archives, you can see that almost every correction and bear market, we've warned our people anywhere from 1 day to 15 days before it happened. And even with COVID, when we didn't see it coming, within the first week after it hit, we were already in cash. So we've got a great record of protecting your money and not being in these markets when they're tanking. So think about that. Go out to TRADEway.com, check out Amped. It's a great program. Okay, now think about it. When they say stay the course, the market will always come back, guess what? So far anyway, they've been right. It always comes back. But you know what they don't tell you? They don't tell you how long it takes. So when you look at the tech bubble in 2000, it took almost 15 years for the NASDAQ just to get back where it was before that happened. What if you were 60 years old, 70 years old? Even if you're young, do you really want to take 15 years of making no money? That's a huge opportunity cost. Whereas with a concept like Amped, you can freeze your money right where it is before the bear market hits. After it hits the bottom, you can buy back in cheap and have the potential to be making money that 15 years rather than waiting, making no money because you're trying to catch back up to where you were 15 years ago. Listen, that is not the way to go. Amped has a much better prescription for life. I don't care what age you are. All right, guys. Well, it's been great to be with you today. I think we're out of time. So I want you to do me a favor, rate and review this if you liked it, because there are other people with similar interests that might find it. We could be a help to them. Have a great day, and we will talk to you soon.